The stock market, ladies and gentlemen, has been blasting off like a rocket ship, causing the fear and greed index from CNN to move into that extreme greed place. And also the biggest bears on Wall Street are starting to flip and be more bullish. We've got a lot of data to discuss on today's Stock Market Brief Show, where we navigate the financial markets through the lens of technical and intermarket analysis. Let's go ahead and get into it. Alrighty, people, welcome back to the show. So yes, Mike Wilson, one of Wall Street's biggest bears, is now saying the Fed is giving investors a good reason to be bullish in 2024. After their last press conference, it looks like the market is pricing in those rate cuts to come, and the market continues to scream higher. Now, many people might think, okay, now's the time to start shorting this because it just keeps going up. But just know that the trend is still up, and there really is no sign of it stopping as of now. So we're going to get more tactical on what that means and what that might look like if you are looking to be tactical from the short side. Yes, the market's moving into extreme greed. This is the fear and greed index from the CNN website. And I wanted to pull up a chart dating back as far as I could to show you what it looks like when we get into this extreme greed state. And over here, you'll see the red line is the S&P 500 and the blue line is the fear and greed index. Over here is when we move into that extreme greed state. And you can see over in this realm, one of the more recent ones, we managed to stay within there for a couple of months. So I went ahead and draw this out to make it very clear and simple to show you the times that we were at extreme greed, dating back as much as data as I could get to May of 2021. So this was the last one, the most farthest I can go back was November. And these are times that it got into extreme greed, and when the extreme greed went from extreme greed and then it started moving to a more neutral state, and that's where I'm highlighting. So as you can see, we fell down, we went up, and we started going down. There's some big pullbacks here. So yeah, after pretty large substantial rallies, which puts us into those extreme greed states, we could see potential pullbacks in the near future. Now, keep in mind this one over here, the more recent one, this one actually lasted for a few months in an extreme greed state. It was until over here when we started moving out of it. And we've been into extreme greed state now for just a few trading sessions. So are we going to continue to stay there, or is the market going to cool off? Well, I wanted to apply some other parts of data and show you kind of where we are at. If we look at back month versus front month volatility, I show you this pretty frequently, where if we come up above that 20%, the market typically can stall out or start to consolidate. But I wanted to highlight these yellow squares. These yellow squares are highlighting the times that we were also in an extreme greed state. So you can see we actually got into an extreme greed state over here within this yellow box, but also back month volatility was more than 20%, and it kept on kind of flickering around before falling that 10% correction in the S&P 500. The other time prior to that was over here, was going into 2023, where we saw that little spike above 1.20, and then the market started to pull back. And then prior to that, we saw some chop going into the new year of 2022 before going into the bear market. So does that mean that we're going to see something similar? Well, after a strong rally like this, it's likely to see a consolidation at some point. But like I said, we will get tactical a little bit later. I wanted to point out this chart too. This was one that I posted on Twitter back on October 23rd. When the market was basically, at a 10% correction. And what I called out was the new lows. And the new lows, looking back to the left of the screen, you can see that we had this capitulatory type of move in new lows. And the last time we had that was after actually a 10% correction. And then the market started going higher. Well, what happened over here? Well, as you can see, the market went just a little bit lower over here, going to 11% correction before seeing an explosive move to the upside. And the reason why I'm bringing you this now is because you can also look at this from the flip side. So we were looking at new lows. Well, what about where we stand for new highs as it stands? Well, just recently we had an explosive move in new highs, a level that we actually haven't seen prior to 2022. So this is really the first time in a year plus that we've seen this high of a reading in the Nasdaq new highs. And the reason why I'm showing you this is if we look back to the side of the screen, what happened when we had an explosive move in new highs? Well, that was leading into 2022, where we started to see some of a pullback. But that's not a big enough size to be looking at, so we'll go ahead and scroll back a little bit further. And what you can see here is this reading. Well, we haven't seen that really since back here in early 2021. So that's a pretty explosive move, and that's when the market actually pulled back a little bit. If you go back further, you saw even bigger moves, bigger moves, bigger moves. And what were happening during these? Well, you saw explosive moves, then it sold off. You saw explosive moves, sold off. But overall, that entire time, what did we see? Well, we saw explosive volatility going both back and forth. And that's really what we're seeing here is an explosive move and we're seeing a pretty significant reading on the new highs as it stands. So are we going to see it potentially, push higher maybe because it's the new, going into the new year, the Santa Claus rally might have some more legs, but just keep in mind that each time that we've seen these, we typically go into a period of consolidation and or some sort of a pullback in the near future. If we take a look at BP SPX chart, that is cruising right at around the 80 marker. The last time it was here was at the August peak, and the RSI is still burnt to a crisp up here at a 87.59. Bullish percent index for the Nasdaq 100 is also, RSI is getting pretty frothy there, and then we're having an 87% reading there on the bullish percent index for the Nasdaq 100, which is a pretty frothy reading. The last time we were actually here was back in early 2022 in April, and that was after a significant bear market rally before heading lower there. And if we look at the BP INFO, so this is the tech sector. The last time I really called out the main divergence was over here going into August, where we had a higher high in price. Same with the bullish percent index, but the RSI was not. It was diverging from that, from both the action of the SPY and obviously the bullish percent index. And we're seeing a very similar situation here where we're getting that frothy reading with a negative divergence that's currently building as the marketplace is kind of just pressing higher and higher. So this could be, if we're going to see rotation, maybe they lay off of tech and they move into the names that have been getting beaten down, which is actually a note from Goldman Sachs that I had stated in a prior video that I shared with you, those charts. Take a look at the bullish percent index for the Nasdaq Composite. Also getting a pretty frothy reading over here, but it's really just above 56. You had to go back pretty far for it to be above those readings. The last time we were up at these levels was August, February, and then August of 2022 with an RSI that's at 92.46. So pretty frothy reading there as well. Dow Jones Industrial Average did have a negative divergence in the RSI as the price action continues to press higher. And we have that divergence that is currently building as it stands. If we take a look at the percent of stocks above the 50-day and the 200-day in the S&P 500. Take a look at these readings. So as breadth continues to enter into the market and the markets continue to press higher, of course, these are going to improve, right? More stocks go up. Well, the percent of stocks above the 50-day are going to increase. The last time we're at these levels was right around going into August, but now we're above 90, which is typically a more extended reading. You can see the other times where it was in August of 2022 and then also December before we saw a little bit of a pullback. And then we actually haven't seen the 200-day stocks above the 200-day this high really since the start of 2022 there too as well. Now, before you get like, oh, these are really bearish stuff, like I said, we're going to have to get tactical. This doesn't mean you just go short willy-nilly, and I'll explain why, and I'll demonstrate, what can happen in those times. But the Nasdaq 100% of stocks above the 50-day and the 200-day, we're at a 95% reading. So not only did I show you some of those divergences within the bullish percent index for the technology sector, but you're also getting really frothy readings heading into 2024. 95% of the stocks are above their 50-day moving average, and we're getting a pretty decent reading there on the Nasdaq percent of stocks above the 200-day, which is at 85%. If we take a look at the summation index, I like to apply a parabolic SAR, and it helps identify potential changes in trend. The last potential change in trend happened there in November, which we had talked about and discussed, and we've been on that trend change. As you can see, the market's been moving up. The last couple of trend changes was a little couple whipsaws as the market continued to move down. We talked about these positive divergences in the Nasdaq McClellan Oscillator, and I'll continue to talk about the ones that are currently building now in the Nasdaq McClellan Oscillator. The market had a high, a lower high, a lower high. The Nasdaq McClellan Oscillator did, and the market continues to press up higher there too as well. So this is bullish, but if this starts turning back around, let us be aware of that because that could identify a potential change in the trend once again or a period of consolidation. The same thing goes with a NYSE summation index for the New York Stock Exchange. Pretty much vertical after the potential change in trend, which is no potential. It was a change in trend. And if I zoom in on the NYSE McClellan Oscillator, you can see that divergence that we've been talking about as the market continues to squeeze, is still building as it stands there too as well. Okay, so the first thought most people see when they see this stuff is, oh yeah, this is probably the best time to short. Well, just be aware that I want to walk you through kind of like the thought process here. So this is just the DIA. I'll go over the Qs there too and the SPX, and I'll get tactical, but just understand that, look at this these days right here. Boom, 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 boom. If you were thinking about shorting here, Well, then guess what happened? Boom, 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 right? So the trend changed and we started moving higher. Well, when we gapped up over here, you might consider short, and we had a big day over here. And then we started continuing to rally. These candles were even bigger, right? So I might short here. And then the candle was even bigger. And then we went to a consolidation, right? Even this day over here, we gapped up, we closed towards the low of the day. Oh, this is where it's going to reverse. No, that's not where it reversed. What about this day? This day was a gigantic move, and I could see why people might want to enter into a fade trade there. Well, guess what? It started continuing higher. So when the trend changes, just know, especially in like this holiday season where we typically get, bullish seasonality, you get strong rallies despite what other things have seen. So yes, we're getting things that are very overbought, very frothy, but there's currently a trend that's in place that has not been taken out. And it's been offering up very little consolidations and very little pullbacks throughout, which lets me know that this is a very algorithmic type rally where people are chasing into year end. FOMO, the buyback period, corporate buyback period, it just hit a record high, and that's coming to the blackout period, and so forth. So just be aware that we were closing at the high of the day, so this thing could continue to press higher. So if you are trying to just scale into a short position or add some hedges, awesome. But if you're trying to YOLO into, and get rid of all your longs, that's where it can get a little dangerous. The same thing goes with the Qs, right? The Qs actually had a little bit more of a consolidation, but then they're ripping, continue to grip higher. Okay, so how do we get a little bit more tactical in this environment? Well, we talk about it very frequently. So we'll look at the 15-minute chart on the SPY. And the first thing I like to look at is the 5-day moving average, and not just the 5-day moving average, but the direction of the 5-day moving average. And the 5-day moving average, the direction is currently inclining. So the short-term trend is bullish. So this is, not something that you necessarily want to fade. You can get lucky and get some points here and there for intraday trades, but just know that if you're, taking oversized large positions, well, what has been happening? Well, nothing good has been happening. As it stands right now, we're up at the upper weekly expected move. We tagged it today on the SPY. Going into tomorrow, we have the upper daily, the lower daily. I added the 2 standard deviation moves for you. You can download this chart deck if you want to have those levels more specifically read out to you. I want to talk about this structure right here, how we had this pull, flag, and we're moving higher, but I'll show you on the SPX chart where we had the pull, we flagged, and we're moving higher over here. Well, a measured move would take us to around the all-time high in the SPX. This is the 30-minute chart. Same thing applies, except I add some other levels. These are gamma exposure levels, and this is where I want to get a little bit more, obviously, tactical with you. So as we're approaching the upper weekly expected move on the SPX, which we already tagged on the SPY, this is, tells us, 68% of the time we close within this weekly expected move. So when we get outside of it, just be aware that the probability is that we pull back within it, or we, maybe come upside and then we, kind of just go around the side of it. And that's, the happy place. We typically tag the weekly expected move. There was 2 weeks, not last week, but 2 weeks prior, we did not tag it. Last week, we exploded past it. This week, I would consider it a tag already. Now, like I said, we have an inclined 5-day moving average. So price actions continues to be bullish there, okay? The trend, short term, it's bullish. Gamma flip level is at 46.90, which is not far from where we're at. But guess what? That's positive gamma territory. So what's that mean? It means dealers, they look to buy the dip, sell the rep. Buy the dip, sell the rep, and that is what's been happening. So let's lay out some really key levels. Yes, I have the daily expected moves here, the weekly expected moves, and so forth as we're moving into it. But if the market wants to press higher, let's hone in on some of these gamma exposure levels. The big local resistance is going to be 4,800, okay? If we start pushing up there, that to me would be more of a cap for the week, as we have, Wednesday, Thursday, Friday left in the trading session. And as we're moving into the holiday season, you typically get lower volume, right? And these lower volume days are easier to manipulate. And, we could definitely see that. That'd be a very strong possibility. So that would be the area of resistance I'm watching. If we can break through that, then yeah, all-time highs would be the next level, okay? Below us, the local resistance is at 47.60. However, below that, I would say 47.50 is a larger gamma exposure level. So if we get some sort of a pullback, that would be the level to look, and that's in confluence with the lower daily expected move. So if you're looking to buy the dip, sell the rip, that would be one of the ways that I'd be looking about it and how to get a little bit tactical in this current environment. I want to close off here looking at one of the bookmap charts. This is ESH24 contract. So I just want to call out, there is a pretty sizable level of liquidity that entered in, midday-ish today, and that's about 600 contracts. we're not far off from that level. These yellow lines are the expected moves. So for tomorrow, straight in session to 48.37 to the upside, 47.98 to the downside. But these type of levels, the longer they hold here, they can act like magnets. So to go up here and fill that level is a possibility. Now, I don't know if they're going to just cut this level off going into tomorrow's trading session, or if it's going to get absorbed overnight. I don't know. But as it stands right now, when I pulled this, those contracts remained up there. Okay. Going into the rest of the week, we don't really have too much going on as far as macro data standpoint. We have GDP growth rate. We'll see if that adds any volatility in the market. That's an hour before the market opens up. And then on Friday, we have some more stuff like durable goods, personal income, spending, core PCE index month over month. That's all an hour before the market opens up. And then we have Michigan consumer sentiment, which usually shouldn't move the markets, but for some reason that has been moving markets pretty significantly intraday, not like on a daily basis, but if you're trading intraday, it's important to know these levels, obviously, because you could just be whiplashed with a big bout of volatility. That's all I got for you on today's episode, everybody. We covered a lot. A lot of things are overextended. A lot of things are fried as we're moving into the holiday season. So don't do anything that could damage your portfolio heading into the new year, as the markets do act a lot different. And once the new year comes around, let's be ready to rock and roll. Let's see you later.